people who are relying on their investments to support their income needs, the most common question we get is, how much income can I draw without going broke? In this video, I explain how we typically work with clients to answer this question. I'll also explain how we structure clients' investments to allow for regular as well as one-off withdrawals in retirement. The tool we use to work through these questions with clients is called Profile Pathways. We also have a version for people who are accumulating assets rather than drawing down from them. There is another video on this site which explains how that one works. So let's run through the case of a couple who are close to retirement and who want to know how they can best manage their assets to support their income needs for the long term. In our example, we have a couple. Chris is 60 and his wife Amanda is 58. The first key decision to make is how long they want their capital to last for. It would be dangerous to just plan for their life expectancies, as half of all people will outlive them. By setting a plan period of a little longer, at say 30 years, we reduce the risk they will outlive their plan. So let's have a look at the capital Chris and Amanda have available to invest. Our couple have accumulated $1.3 million to support them in their retirement. They would like to have 10% of that amount, or $130,000, remaining at the end of the plan, as a buffer and to remain in their estate. Chris and Amanda aren't expecting any additional investments, so the next step is to understand what drawings they're planning to make against their assets. Our couple would like to draw about $100,000 a year from their investments. This should cover their anticipated expenses and spending needs. We'll assume that income drawn grows with inflation. However, there are a couple of lump sum expenses coming up that Chris and Amanda will need to allow for. They're planning to renovate their home next year and expect that it will cost about $80,000. Their car is getting on a bit and they'd like to upgrade it at some stage. They're expecting to spend around $30,000 on that in about 5 years' time. So we're at the point where we understand the assets our couple have and what they need those assets to deliver and when. Now we can begin the process of designing an investment strategy that has a high chance of delivering on those goals for Chris and Amanda. In our view, the prime consideration when you're investing your money for retirement is when do you think you'll want that money back? That decision on time frame will drive many other decisions about the way your money is invested. There are a couple of other videos on this site that explain our investment philosophy in a bit more detail that I'd also encourage you to view. For now, let's have a look at how it might work for Chris and Amanda. In line with our time frame approach, the first step is to work out what assets will be needed by our couple in the next 3 years. This will be a combination of any lump sums Chris and Amanda know they'll need, such as the home renovation, as well as the first 3 years of income. Because we know the clients will need the money back pretty soon, it will need to be invested in assets that have basically no risk of loss, like cash and term deposits, which in combination will probably earn a little more than the RBA cash rate. At the time of making this video, we assumed people could earn around 3.5% a year from these types of assets. So to work out how much they need in this bucket, we do a quick calculation. And the answer is just under $370,000. We call this bucket, or portfolio of investments, the foundation portfolio. Okay, so now we have the first 3 years covered. What's next? Just like with the foundation portfolio, our next decision is to work out what Chris and Amanda will need for the following 3 years. That is, years 4, 5 and 6 of their plan. Like before, we look at any lump sum needs our couple will have in those years. For example, upgrading the car, as well as the indexed income the assets will need to generate for those years. So let's calculate that amount, which is just over $313,000 in this case. This portfolio we refer to as preservation. One of the key differences when investing for years 4, 5 and 6 is that we have a bit more time for those assets to grow. Because we know our couple won't need to touch this money for at least 3 years, we can afford to use assets that have a somewhat higher potential for growth than cash and term deposits, and ride out some of the occasional short-term losses. 3 years still isn't a very long time, so an aggressive share portfolio certainly wouldn't be right. However, assets like fixed interest or conservative managed strategies can be used. In this 3 to 6 year time frame, we think a reasonable investment return to be aiming for is to outperform inflation by 4% a year. So that's about 7% a year if we assume the Reserve Bank can keep inflation within 3% a year. So that's the first 6 years taken care of. Now we need to consider the remaining 24 years of our couple's plan. We call this the accumulation portfolio. The first 6 years of Chris and Amanda's needs are already covered in the foundation and preservation portfolios. So we know there won't be any need to access this money in accumulation for at least 6 years. Because of this, we can afford to use assets with even higher potential for growth than preservation. So here we can use assets like shares and listed property or more aggressive managed strategies, investments that over the longer time frame tend to deliver strong returns, even though in the short term they can be very volatile and suffer losses. Chris and Amanda can ride out volatility with this money because they're not relying on it to support their immediate needs, and so won't be forced to realise losses in a down market. So in this 6 year plus time frame, we can reasonably target a higher investment return. In fact, we aim to outperform inflation by 6% a year. That's about 9% a year if we assume inflation is 3% a year. Okay, let's just draw breath here for a moment because we've just galloped through quite a lot of information. I guess the key concept here is that the sooner you'll need your money back, the more conservatively it should be invested. And on the other hand, the longer you can afford to leave your money, the more risk you can afford to take with it, because short-term losses can be ridden out. There's a fair bit of science behind why we've selected the particular time frames and investment return targets I've spoken about. If you'd like to delve into that element a bit more, just give us a call. So let's have a look at the results of this initial run through for Chris and Amanda. If you've been keeping track of the minimum investments we've discussed, you may have already had an inkling that our couple have a problem. You can see here the minimum investments we've just calculated add up to just over 1.56 million. However, Chris and Amanda only have 1.3 million to invest. So they have a shortfall of almost $270,000. Our couple will need to review their plan. The first change relates to the income our couple will need. On reflection, they think that in 5 years' time, they'll be able to reduce their annual income needs to $90,000, as they expect their expenses, particularly regular travel, to be lower. They also think that they could reduce their home renovation budget by $20,000 to $60,000, and their car upgrade costs by $10,000 to $20,000. Finally, it is likely they'll be downgrading their home when Chris turns 75. They plan to move to a townhouse or an apartment, which will involve less maintenance. Allowing for all the costs of moving, they expect this will free up $100,000 in home equity, which they will invest at that time. So let's see the impact all these changes have on the results. After recalculating the amounts required for each portfolio, you can see the previous shortfall of almost $270,000 has now become a small surplus. You can see here to the right an illustration of the plan. The green line shows the regular income being withdrawn each month. The blue shaded area shows the total value of Chris and Amanda's portfolio over time. You can see the withdrawals early on for the home renovation and new car, and later the addition of capital from the release of the home equity. Planning ahead is vital, but even so, in real life, things often change, so you just can't set and forget. Unexpected expenses, as well as windfalls, can happen. Legislation and government benefits change. For example, if you're also receiving some age pension and the amounts or eligibility rules change, that will affect what you need your private investment assets to deliver. And of course, investment markets might return more or less than expected. Because of this, we review our clients' complete plan at least once a year to ensure that changes are taken into account and that clients can sustain a comfortable lifestyle. Thanks for your time.